Bookkeeping Ethics and Professional Standards in the United States. Introduction. Welcome to our video on the ethical responsibilities of bookkeepers and accounting professionals in the United States. Bookkeeping, as a vital component of accounting, requires strict adherence to ethical standards and professional guidelines to ensure the accuracy, integrity, and trustworthiness of financial information. Today, we will delve into the essential ethical principles that guide bookkeepers and accounting professionals, focusing on maintaining confidentiality, avoiding conflicts of interest, and upholding integrity in financial reporting. 1. The importance of ethics in bookkeeping. Ethics in bookkeeping is not just about adhering to laws and regulations, it's about fostering trust and credibility in the financial information that businesses and stakeholders rely on. Ethical bookkeepers uphold principles that protect the integrity of financial data, ensuring that all records are accurate, complete, and transparent. This trust is foundational to the smooth operation of financial markets and the economy at large. 2 key ethical responsibilities. A. Confidentiality. Definition and importance. Confidentiality involves safeguarding the information obtained during the course of one's professional duties. For bookkeepers, this means ensuring that sensitive financial data about the company, its employees, and its clients is protected from unauthorized access and disclosure. Practical application. Bookkeepers must handle financial records with discretion. This includes secure storage of documents, cautious handling of digital data, and judicious sharing of information only with authorized personnel. For instance, a bookkeeper should never discuss a company's financial details outside of work or share passwords and access codes. Consequences of breach. Violating confidentiality can lead to severe consequences, including loss of trust, legal action, and financial losses for the company. It can also damage the bookkeeper's reputation and career. B. Avoiding conflicts of interest. Definition and importance. A conflict of interest occurs when a bookkeeper's personal interests might interfere with their professional duties. This can compromise their objectivity and integrity. Practical application. Bookkeepers should avoid situations where their impartiality could be questioned. This includes not engaging in financial transactions that could benefit them personally at the expense of their employer or clients. For example, a bookkeeper should not accept gifts or favors from vendors or clients that could influence their professional decisions. Consequences of breach. Conflicts of interest can erode trust and lead to biased financial reporting. If a bookkeeper's actions are seen as selfing, it can damage the credibility of the financial statements and the organization's reputation. C. Upholding integrity in financial reporting. Definition and importance. Integrity in financial reporting means providing accurate and honest financial information. Bookkeepers must ensure that all transactions are recorded correctly and that financial statements present a true and fair view of the company's financial position. Practical application. Bookkeepers should adhere to generally accepted accounting principles GAAP and avoid practices like misreporting revenues, understating expenses, or engaging in creative accounting to manipulate financial results. For instance, they should report all expenses as they occur, even if it reflects poorly on the company's performance in the short term. Consequences of breach. Failing to maintain integrity in financial reporting can lead to significant legal and financial repercussions, including fines, penalties, and loss of investor confidence. It can also lead to severe damage to the bookkeeper's career and the organization's future. 3 Professional standards and guidelines. A. Generally accepted accounting principles GAAP. Overview. GAAP provides a framework for financial accounting and reporting, ensuring consistency, reliability, and comparability of financial statements. Role of bookkeepers. Bookkeepers must be thoroughly familiar with GAAP and apply these principles in their daily work. This includes proper revenue recognition, expense matching, and full disclosure of material information. B. American Institute of Certified Public Accountants ICPA Code of Professional Conduct. Overview. The ICPA Code of Professional Conduct outlines ethical principles and standards for CPAs, which also apply to bookkeepers working under their supervision or within their organizations. Key principles. The code emphasizes responsibilities such as integrity, objectivity, and due care. Bookkeepers should use the code as a benchmark for their ethical behavior and professional judgment. See Continuing Professional Education CPE. Importance. Staying updated with the latest developments in accounting standards and regulations is crucial for maintaining ethical standards. Implementation. Bookkeepers should engage in regular professional development activities, such as attending workshops, seminars, and courses. This ongoing education helps them stay current with changes in the industry and uphold the highest ethical standards. 4 practical scenarios and ethical decision-making. Scenario 1. Handling sensitive information. A bookkeeper discovers an executive's misuse of company funds. The ethical action is to report the discrepancy to the appropriate authorities within the organization, maintaining confidentiality and following proper channels. Scenario 2. Avoiding favoritism. A bookkeeper is offered a substantial gift from a client during the holiday season. Accepting the gift could compromise their objectivity. The ethical choice is to politely decline the gift and inform the client of the company's policy on such matters. Scenario 3.